Hey traders, welcome back to the channel. If you've ever wondered what's the best technical trading strategy, you're in the right place. Today, I'm going to walk you through a powerful three-part strategy that helps identify stocks with a high probability of rising. We'll talk about all-time highs, moving averages, earnings growth, and most importantly, how to think like a contrarian when the market is full of fear. Let's dive in. Let's start with the first and most important criterion. The stock is trading at an all-time high. Now, I know what you're thinking. Isn't that the worst time to buy? Actually, no. Here's why. When a stock hits an all-time high, many investors hesitate. They fear the price is too expensive and expect a correction. But this fear creates a pool of potential buyers who are still on the sidelines. If you buy now, you're betting against the crowd. And historically, that's often a winning move. Because if the stock keeps rising, those hesitant investors will feel FOMO, fear of missing out, and jump in later, pushing the price even higher. Example: think about Apple or Nvidia. These stocks have hit dozens of all-time highs over the years, and each time people said, "It's too late." But the trend continued. Caution: don't blindly buy every stock at an all-time high. Check forums, analyst reports, and sentiment indicators. If everyone's overly bullish, it might be a sign of euphoria, not strength. In that case, step back. Next up, the 200-day moving average. This is a classic technical indicator that shows the long-term trend of a stock. If the stock is trading above the 200-day line, it's generally in an uptrend. But here's the nuance. If the price just jumped above the line due to a sudden spike, that's not a trend, it's noise. You want to see the stock consistently trading above the 200-day line for months, ideally a year. Why it matters. A sustained position above the 200-day average shows institutional confidence. Big players, hedge funds, pension funds are likely accumulating, and that's a trend you want to ride. Third criterion, earnings growth. Specifically, look for companies that have shown profit growth over the last 2 years. Why 2 years? Because it filters out short-term noise and shows whether the business model is truly working. Consistent earnings growth means the company is expanding, innovating, and likely reinvesting in future growth. It's a sign that the fundamentals support the technical setup. Example: a tech company with rising revenue, expanding margins, and growing net income is far more likely to sustain a bullish trend than one surviving on hype alone. Now let's be real, stocks don't always follow the rules. A stock can rise even if it's not at an all-time high below the 200-day line and losing money. And a stock can fall despite meeting all three criteria. That's the market. It's messy, emotional, and unpredictable. But here's the key. These three criteria don't guarantee success. They simply increase the probability of a successful trade. And in trading, probability is everything. Let's talk about protection. Even the best strategy needs a safety net. Always use stop-loss orders. Set a level where you'll exit the trade if things go south. This protects your capital and keeps your emotions in check. Pro tip: don't set your stop too tight. It'll get triggered by normal volatility. But don't set it too wide either. You'll risk too much. Find a balance based on the stock's volatility and your risk tolerance. So, to recap, the best technical trading strategy combines three powerful signals. The stock is at an all-time high. It's trading above the 200-day moving average. It has shown earnings growth over the past 2 years. Use these as filters, not guarantees, and always protect your trades with smart risk management. If you found this video helpful, hit that like button, subscribe for more trading insights, and drop a comment below. Have you ever bought a stock at an all-time high, and how did it turn out? Let's talk strategy in the comments. See you in the next video.